most expats completely ignore their UK state pension because while £230 a week or £1,000 a month is a reasonable amount of money, but if you retire in a place like India with a lower cost of living, that's about 1 lakh rupees per month. Or if you're a couple, it's 2 lakh rupees a month. So if you are a UK expat but thinking of retiring in a place with a lower cost of living, just living on your UK state pension is enough to give you a very comfortable retirement as long as you know the rules. To be eligible for the UK state pension, you need to contribute for a minimum of 10 years. And I'll show you, if you're a homemaker, how you could absolutely get this without any contribution. And to get the maximum state pension, you need to contribute for a full 35 years. The state pension age keeps rising. Currently it's 66, it's soon to be 67. And from 2044, it's going to be 68 years old. You can claim your state pension. If you log into your personal tax account on HMRC online, you can find your NI contributions and where you are up to with your forecast. So this is my personal HMRC account. I've blurred out a few things like my NI number and things to keep things confidential. Click on NI insurance or state pension and then click on the state pension summary. It'll show you your rough forecast till date. So based on my contributions, I'm qualifying for £183 currently and my retirement age is in 2047 and I need to contribute for another 8 years to get the full state pension. Some of you on your personal tax account, you may be given a choice to purchase additional years. Do your own research and do some more reading about it. This may be a good option. Like a person like me, I need another 8 years before 2047. So for me, purchasing additional years is not a good idea. But for some of you, if you're a few years short for a full state pension or even the minimum state pension, it may be an idea to purchase additional years, but do some more research about it. If you retire in the UK, your state pension keeps up with inflation. There's something called a triple lock where it increases by a set percentage or a set amount per financial year. So the state pension is inflation linked and it just goes straight to your bank account if you retire in the UK. However, if you retire abroad, there are certain countries, I'll just put it on the screen here, in certain countries, you still get the triple lock. So it rises by inflation in these countries. But if you retire in other countries, the state pension is sort of frozen when you leave the UK. So for example, if I retire at present and go back to live in India, my state pension is frozen at £183 a week. So basically it doesn't rise with inflation. That's the only thing. It's frozen in time and you'll still get your state pension, but it doesn't rise with inflation in certain other countries. And I can get my state pension either in my UK bank account and transfer it then, or give HMRC my details and they will send it to my bank account in India. So if you are an expat watching this, there's 3 things that you need to do to secure your state pension. First is to log into your HMRC personal tax account and find out your NI contributions and monitor this on a regular basis. The second is if you have been a homemaker and looking after young children at home. If that is your situation, if you've stepped back from work to look after a young family, up to the child's 11th birthday, the youngest child's 11th birthday, you can claim NI credits. And I said previously, you need a minimum of 10 years contribution to claim the minimum state pension. And you can claim NI credits up to your youngest child's 11th birthday. The way to do this is to claim for state benefit. To claim child benefit, there's 2 further things you need to be aware of. One, it's a public welfare. So if you're not eligible for public funds, you're not applicable till you got your PR and things, and then you can apply for public funds. The second thing is many people do not claim child benefit because your salary threshold is over £80,000. But on the child benefit form, there's a little box that you can tick in page number 7, I think. There is a section for high earners. And there's a little box that you can tick saying that your salary does not qualify for you for child benefit. But because there's an adult who stepped back from their career to look after the children, you want NI credits for that person. You can backdate this child benefit and the NI credits only by 3 months. The other thing you need to do if you plan to leave the UK is just keep a UK bank account open. In case there's any hiccups or any problems, you can still receive your state pension to your UK bank account and then you can transfer internally. The other thing you need to do is 4 months before you qualify for state pension is to contact the International Pension Center and to get your paperwork and things processed. So when you hit state retirement age, you can get your pension automatically. If you've stayed so long, you're probably very serious with your finance. You probably want to know if it's wise to overpay your mortgage or to invest the difference. I've done a whole video on that. Feel free to check it out. I'll see you in the next video.